kind of, it depends on that. If you've got your own property and you rent a room out, then you can rent a room for a limit of, I think it's £7,500. So you can rent a room out £7,500 a year, no tax. Okay, so that's a room in your own property. If you have a property for you and then you're renting out a different property, then there is tax on that. So there's tax on the income that's generated from that property. Now there are deductions against the income. So if you get your rental income of £1,000 a year, if you have costs associated with that rental income, then they get deducted, giving you a rental profit effectively, and you'll get taxed on that. Now, how much will you be taxed? It does, not kind of, it does depend on your other forms of income as well. For every individual each year, UK resident we're thinking here, and UK properties, they'll have different slices of income, most likely, and there'll be probably a salary. There may be some banking interest if you're very lucky, possibly a little bit of dividends, and there may be some rental income, and there may be other bits in there as well. But so you have to add all of that up, and then your income is calculated over that global position. But yeah, so if you rent out your property, then yes, there are tax consequences, there is income tax, but how you calculate that is very dependent on your personal circumstances. And if you go broad brush, if you have an income, you can largely set off costs which are required to be incurred for generating that income. So you have a property, you get some income from renting it out. Think about those costs that you're likely to have. Possibly some legal fees on setting up a rental agreement, some fees for the estate agent possibly, or the letting agent, some fees for repairs, a gas safety check, all things like that. They're all costs that you would incur for running that property as a rental property, and so they're deductible against that income. So wear and tear is an allowance that disappeared a few years ago. That was just a general allowance that said, well, we'd guess that there's going to be an amount of wear and tear which you're going to have to repair. We'll not get you to add it all up, but that's gone. So these days you do need to show that you are incurring the costs to get the deductions, the tax deductions, income tax deductions, and so that is the thing in relation to the wear and tear. You have to think about the costs that you are incurring. So that will be someone to come around and paint the house as required, repair carpets, anything that you think is required. Tax advantages. I think probably it's more. There are commercial benefits if you think about benefits of scale, economies of scale that you can get from renting multiple properties. I think I touched upon stamp duty, multiple dwellings relief if you buy a lot of properties at once. The stamp duty if you have more than 6 properties, I think it is. So there are some benefits there. Other tax benefits, well, it's slightly tricky. I've said it a lot, it depends. So I would tend to suggest if you have a large number of properties that you're renting out and you have a significant amount of mortgages to finance the purchase of those, then the likelihood is it's probably going to be good to have those in a company because of the way that the tax relief you get on the interest relief you get on the mortgage interest. So there can be benefits, but that's almost like a change in what's the optimal tax position rather than specific tax benefits for having multiple properties. So we kind of touched on this earlier. If you sell your rental property, you probably would have bought it. If you haven't bought it, you may have inherited it, but so that's the effective cost at acquisition. So you possibly inherited it or you've purchased a property. That's the base cost. You're making a sale now. The sale, the proceeds, less costs that are attributable to that. So legal fees, estate agents' fees. That reduces the proceeds. You've then got the costs associated with buying that property and bringing that property to the state that it is in currently. One less the other gives you the gain. Now, as I talk about the the money you've spent on the property. Of course, either you have repaired a property and so you get income tax relief, or you have improved the property in which you get capital gains relief. You don't get that relief twice on the two different taxes. It's either one or the other. It's a matter of fact, which it is, but yeah, so you've got to be careful about making sure you think about the costs that you've incurred and which you've got relief on throughout the ownership of the property and which are related to improving it. So as I said before, if you're doing a large improvement, you're putting on a conservatory or putting on an extension, that's an improvement to the property. That would be a gain deduction, as opposed to painting is going to be an income tax deduction. Right, so we touched upon the rental room relief. So if you live in a property, rent out one room, PPR, I think it was you're talking about. I mean, it is your property, so it's your single property, and so you get the full relief. If you live in a property, move out, someone moves in and rents it, and then they move away and you move back in again. When you come to sell, there's clearly a period of occupation where it's your principal private residence, and there's a proportion where it's not your principal private residence. And effectively, you do an equation that says the amount of time that's been my PPR divided by the total amount of ownership. That's the amount I get relief on, and the other bit is the taxable element. There's a slight benefit on that. There's a 9-month assumed PPR. Actually 18 months, but 9 months assumed PPR, so it's slightly better than that. You can only have one PPR at a time though, and again, it's considered a matter of fact. You know, it's your PPR is where you live, where your polling card goes to. When your main bills turn up, when your credit card bill turns up, it's a matter of fact that is where your PPR is, and you can only have one. A married couple can only have one between them. If you pass with properties in your estate, they form part of your estate. IHT works in a way that it adds up everything that you own. There's a small there's a tax-free amount that you can have, and then after that everything is taxed at 40%. So your rental properties, the way band it's called, but the rental properties, they form part of your estate, and so effectively they're likely to be taxed at 40% of the value of them. What else can we do? I mean, you can try and pass them away early, so you pass them on so someone else can inherit them early. But if you were to give them and then not survive 7 years, then actually you may have capital gains tax to pay on the gift of that to someone else, and then you've still got the inheritance tax to pay anyway. So you've got to be careful. You know, you've got to think about how much longer you've got to go before you give them away. So tax planning ways, a lot of the time you just want to leave them in the estate, but it really depends on people's personal circumstances. But yeah, so effectively they form part of the estate. Whoever inherits the properties inherits them with a base cost. We talked about that earlier for the gain. They inherit them at the value at death. There is, it depends as always, as I've said before, but let's say you're a non-UK resident and you have a UK property. There's something called a non-resident landlord scheme, so where fits into exactly what you're saying, and most agents should understand what the scheme is. Effectively, this is letting the revenue know that you're in that position. You receive the profits of that rental property gross. If you don't apply for that scheme, then you'll be receiving them with 20% deducted. It's a cash problem. So it doesn't actually change the taxable position. You still have to submit with the tax return. The tax is still calculated in the same way, but it does depend on when you receive your cash. So either the government keeps 20% until you submit it, or you get it full and then pay the tax later on. As a non-resident, you still get a personal allowance. So there's an amount that you can get tax-free. So you get taxed as everyone else would, but only on the UK income element of your income when you're out overseas. Right, so UK, if you're a UK resident, then you are taxable on your worldwide income. So we can see that. So if you get any income from UK properties, then obviously taxable. Now, of course, the interesting bit on that is there's UK tax on any of your foreign properties as well. And in those jurisdictions, you'll often be in the case where you may need to pay taxes in local taxes there. There's normally a double taxation agreement between two countries, and what effectively ends up happening is you pay the higher tax of the two jurisdictions. So if you pay some in the other jurisdiction that's less than it would be in the UK, you top it up in the UK. If it's more in the other jurisdiction, there's none to pay in the UK. So that's broadly the way it works for non-UK properties. But for UK properties, as I said before, it sort of adds up with your other income, and yeah, the tax gets calculated at the end of that. So the only general thing I would say is be careful. There are 7 major taxes in the UK. I'll go through them. You've got income tax, national insurance, capital gains tax, inheritance tax, VAT, stamp duty, I missed one, corporation tax, there we go. So 7 major taxes. Often people will have that conversation down the pub. I hear this is the easy way to save tax. Please be careful, because the likelihood of tripping up on another in trying to save one is huge. So be careful, take advice. Yeah, there's many pitfalls out there.